Hello and good evening, everyone. Welcome to a new episode of Investing Fool. The markets have been in a corrective mode for the past couple of weeks. Many stocks have lost quite a bit of ground from their all time highs and have slid down. Portfolios are also impacted across the board. It doesn't matter whether you are a momentum investor or you are in mutual funds or you are a quality, value, whatever kind of investor you are. If you have been staying invested in the market, it is highly likely that you have seen some bit of correction on your portfolio. So in today's video, we'll talk about how the market is shaping up, what the portfolio is doing, but more importantly, if and when the market corrects further, what is going to be the structure of our mindset and our approach in terms of the strategy. So and before I get started, for anyone who is new to this channel or watching our channel's video for the first time, we started by publicly tracking a momentum portfolio composed of top 20 momentum stocks from the Nifty 500 universe. We started doing this around a year back, and within the next month, we are going to be completing 1 year of this portfolio. If you like to be a part of this journey for like education and learning purposes, then please feel free to join the community by hitting the subscribe button on this channel. And if you like this video, please hit the like button. Yeah, the disclaimer, of course, that you have to do your own due diligence before investing. This is just for educational purposes. So where are we in terms of the market? So if we look at our core portfolio, we have come down 9% from the all-time high. And if we look at India as a country, we have corrected more than global markets, but we had also risen more. When the times were good, we had also been rising more compared to our global peers. So we have corrected also a fair bit from there. And but when I say our core portfolio is down 9% from the all-time high, we have to put it in context of how other portfolios, how other indices have been doing, right? And if you see on the right-hand side, I've added the fall from the all-time high for many indices. Then you can see for the broader indices like Nifty 50, Nifty 200, Nifty 500, all have corrected in the ballpark of like 8%, right? If you look at single factor momentum indices like Nifty 200 momentum 30, Nifty mid cap 150 momentum 50, Nifty 500 momentum 50, these have corrected in the range of 9.5 to 10% already. Nifty 500 value 50 has also corrected by 11%. So this fall is not constrained to any particular factor. You cannot just say that okay, momentum stocks will fall much more. The pain is across the board. That is the point that I'm trying to illustrate here. Sure, some factors may correct a bit less compared to some other. But if you look at the broader indices, if you look at other portfolios, there has been quite a pain, and it's kind of like equally distributed, right? So you see here Nifty 200 quality 30 has also corrected. Our portfolio has corrected by 9%, and we are not better than or worse than anyone else. Overall, I would say everything has corrected in a very similar ballpark. And if when everything corrects, when the pain is across the board, then there is no real need to panic. We should be kind of expecting these kind of falls, at least after such a long run of good times. And this, like if we go for a time correction, right, maybe a few months, the index doesn't move anywhere, right, that will provide sort of a healthy base for a next rally. That could provide, I'm like not saying it will, because no one can know what the market has for us in the future, but this has happened in the past as well, and we'll discuss about that. But it is very important to not panic, to just stay invested, and to handle this phase as well, because this also boosts your confidence. If you have started new in momentum investing, it also boosts your confidence in your own strategy, because you need to be able to stay invested during these times as well, so that you can see good times when they come, right? And some or the other time they will definitely come, right? In terms of monthly performance, October may be our first red month after a run of 6 positive months. So you can see in the month-on-month performance, you can see from April to September, our benchmark, our index, which is Nifty 500, was in green for all of those months, and our portfolio was also in green. It was good times. But if we see here now, we have corrected a fair bit. and this is just the fall in October. So we have corrected by 7.5% in October, and yeah, so if October ends like this, which I see a very high likelihood of happening, because there are only 4 sessions left in October, and I don't see any quick recovery happening in the last 4 days. So if everything stays like this, October is going to be a huge red month after quite a bit of green months. Right. The third point that I wanted to share is when everything falls, the relative ranking may not vary much. So the way we choose stocks for our portfolio, we do it basis a relative ranking based on some metric, right? You can take last 1 year performance, we take volatility adjusted performance, which is the sharp returns. But when we are looking at this long horizon and everything is kind of correcting, then the stocks in relation to each other, they would not move much. So it is possible that some stocks who post really bad earnings, they are going to get hammered. That can always happen. Some sectors may gradually start to go out of favor, but overall the when everything is falling like pretty much, then overall your portfolio constituents may not change as much. For example, if I have to like rebalance my portfolio today, then only 2 out of the 20 stocks, we have 21 stocks now, but only 2 of those 21 stocks will actually exit, and they too will not exit because they are beyond rank 50, which is our primary exit criterion, right? They will go out because they have corrected more than 25% from the all-time high. So these 2 stocks are PGEL and sorry, not PGEL, PCBL here and Godfrey Philip. Both of these you can see have fallen by more than 25%. So if I had to rebalance today, then I would take these stocks out of my portfolio. But obviously I'm not going to rebalance today. We are going to rebalance at the end of this month. So we'll see where the stocks stand at that point of time. One factor that has been there in the market is that the earnings has been a mixed bag. Some companies are posting like good results. I had shared multiple updates on X regarding some of our portfolio stocks. Bajaj Auto came up with its results. Inox Wind was there. Zomato was there. I think many other stocks were also there. But so you have to remember one thing, then when the entire sentiment of the market is really good, then even at par performance also makes investors happy. When the sentiment itself is horrible, then even your stock beating some analyst estimates or some brokerage estimates, that would not make anyone happy. You saw what happened with Dixon, right? Beat estimates, but stock was 10% down. It was hammered because you have reached a point of valuation where like even a little bit of concern on any front is going to affect your price massively. And this is not to say that Dixon is going to start correcting from here on or anything like that, right? It may as well recover pretty quickly. But at least although we are not using earnings or any fundamental metrics for entries and exits in our portfolio, it is always I always keep that in mind, that at least my conviction in a stock remains higher if the earnings are consistently good. So yeah, that's one other factor. A related point is that consumption has been like down, and it is remaining down in a very secular fashion. So we have been seeing what is happening with the auto pack. In our last videos we discussed auto FMCG consumption, and I'll just repeat the same point, right? Consumption, like there is a lot of concern now in consumption. The way the management of different FMCG companies and other consumption companies are commenting about their numbers and their growth and their outlook about the future, it is likely that the revival that was kind of expected in consumer demand, that is nowhere close to what the market was expecting, right? If we look at the sectors, so let's just take a look at the sectoral and other indices tab. So you can see here last 1 month which stocks have performed the worst, right? So Realty is there, this is the worst performer, but below that we have Auto, right? A 1 month return is minus 13.5%. We have Media minus 11.8%, but look at the next two, right? Nifty Consumption down minus 11.3%, Nifty FMCG down minus 11% in the last 1 month. So consumption as a whole, that basket is just not performing well. And if we look at the same time period, if we look at which sectors have been the least hit, right? So the least hit has been IT and pharma. So pharma is down just minus 3% and IT is down not even minus 1%, right? So these two typically considered very conservative sectors, these have been kind of holding their own while the other sectors are falling above, right? So and momentum being a self-correcting strategy, when stocks go out of favor or when the market outlooks turns very defensive, right, then we may get more exposure in such defensive sectors and stocks going forward. Already it has started happening. You can see that our portfolio already has I think six pharma stocks now, and if we have to rebalance also, the next stocks that are waiting to come in the portfolio would be something like Piramal, Divi's and Sun Pharma. All of these are pharmaceutical companies, right? So momentum will automatically go out of sectors that seem to be losing their performance, losing the touch of performance, and into sectors which are starting to perform, not starting to perform, but when we apply that same metrics in that look back period, they appear to be better placed compared to other competing sectors. So yeah, this point I have discussed before. Also, tight filters do not help. So many people can just come and say, okay, look at what happened with Cochin Shipyard, what happened with some of these other stocks. You should have very tight filter, like something like I don't know, 20 DMA, 10 DMA, or 10% fall from the top. You should not look at it at a with a on a case to case basis, right? That this stock I had in my portfolio, if only I could have sold it at the top, if only I could have sold it with 5% correction, then I would have retained so many of my gains, and now I didn't sell it and now look at where I am, right? You shouldn't take it on a case by case basis. So if you actually have to learn the implications, because it will cut both ways, right? So then apply the same to multiple years of backtesting data, and then see how your CAGR, your rolling returns, and your drawdowns get impacted with that. Because there are a lot of whipsaws when everything starts falling. It is very easy to come and say, okay, I should have sold at the top and I should have gotten out with 5% of pain or 10% of pain, right? And why do we use relatively loose filters? But it's not as simple as that. So one very kind of philosophical thing that I wanted to share is that this is actually a good time for you to get some grip on your strategy, or also to get some grip on although it's not that big of a correction, but if we correct more, then it would be an opportune time to for you to know your risk appetite. And for anyone who is new in momentum investing, it just reinforces the fact that momentum is not a magic bullet to solve all your problems. It's not a one size fits all thing, right? That you can just pick up and you will only see the good times, because we have seen good times in the past 4 years. It is not going to be like that, and this is a stark reminder of why we should be very aware of the risks in momentum investing and the long periods of pain that we can endure while following such a high beta strategy. Gold remains strong, and I've said this before also, that it should be a part of your asset allocation strategy. And if you look at the performance here in this sectoral sheet only, if we look at gold, so gold has actually given 11.3% returns in the last 3 months. If you look at the other sectors in the last 3 months, and this of course involves the kind of growth they have seen in October, not growth, decline they have seen in October, but if you just compare the last 3 month performance, gold is 11% up, and it has beaten all the sectors, right? What is the best sector that has performed here? Maybe pharma. Pharma has gone 4% positive in the last 3 months. Gold has given 11.3% positive, and this is gold bees. This is all that despite that custom duty removal by the government and all that, right? So so gold definitely should be part of your asset allocation, and currently it is showing some bullish momentum, and we'll see how it pans out on to early 2025. So this is where Nifty 500 is, which is our benchmark index. If you look at the red line, so the red line is 200 DMA. We have still not hit the 200 DMA, right? And as per our strategy, we have discussed earlier that, so what do we do when our base index goes below 200 DMA? Is that we stop buying any new stocks. So we stop making any fresh entries, but we do not go to cash, like we do not sell everything and go to cash, and we'll discuss that also. Let's look at a broader time horizon. So if you look at the 200-day moving average, so from like what is this, April of 2023, right? From April of 2023, there has been no time in the past we have had a fantastic run when the Nifty 500 index is even close to touching the 200 DMA, right? And now also we are some time away. Hopefully it doesn't come that close. But let's look at a longer horizon of what happens, right? So here we are in 2021. So personally, why I do not go to like all equity or like entry and then full 100% cash and then again entry and the full 100% cash, it is because of these kind of whipsaws that come. Any moving average is a lagging indicator. If you see here, so we made a top in October of 21, right? So this is October 21, we made a top here, and then for the next 8 months we did nothing, right? The market kept going down, up, down, up, down, up. इसी टाइम पे रशिया यूक्रेन वॉर भी स्टार्ट हो गई, राइट? सो 2022 Feb is when the Russians attacked Ukraine, and like global markets went haywire after that for some time. But the point I'm trying to make here is that so we make a top here, then the market start correcting. The index fell below the 200-day moving average here. Okay, so if you feel like you have to sell everything when that happens, because typically a 200-day moving average is seen as the start of a bear market. I mean, that's the common conception. But if you look at the curve of the index, so it goes below the 200-day moving average, then snaps right back up, right? So again you enter here. After some time, this was a false breakout, right? It went nowhere near this high, it was actually smaller than that, and again it crashed, right? The moment it crashed, and this fall is after the Russian war, I think around the beginning of February. But anyway, so again the index falls, right? It falls. So you again make changes here, and then again it goes up. It goes up and again it comes back. It almost touches the 200 DMA, doesn't cross it this time. Again it breaks out, right? Okay. Okay. Let me come here. Yeah, again it breaks out, and then again it goes beyond that. Now this is when we start this run, right? So this is April of 2023. This is like when like the index goes above the DMA and it just continues going, right? From there on we have a pretty happy picture. So because such things can happen, and this happened only for 8 months, right? If you see this kind of index going below the 200-day moving average and coming above, then again going below, coming above, and all that thing, it happened only for 8 months. But there is no guarantee that it cannot happen for 8 years also, right? We haven't seen that in the Indian context in the past. But these kind of whipsaws lead to a lot of churn, lead to a lot of in and out. If you go to full cash, like it's just a lot of in and out, which I'm like not really comfortable with. So my strategy has been a limited one, right? So if the market like corrects a lot from here, right? So someone who would have gone to completely cash, they would be benefited, right? I won't be benefited. My strategy is that I just wouldn't take any new stocks. Whatever stocks are there in my portfolio, they will remain. Rebalancing will continue happening. We'll discuss all that. So yeah, we will just discuss all that in the next slide here. Before that, I'll just share this point on which stocks have fallen the most in my portfolio. So we have PCBL at 27%, Godfrey Philip at 25%, Inox Wind at 22%, and Bajaj Auto at 20%. You can look at all these charts. All of them are like carbon copies of each other. They have, and that's what I'm saying. There is a lot of like risk. All equities will kind of fall together. So it doesn't matter whether you're from chemical sector like PCBL, whether you are consumption, whether you are renewable energy, whether you're auto, you're kind of falling. And it doesn't matter whether you're a small cap, whether you're large cap. Like I mean, small caps will correct obviously a fair bit more than large caps, but in context of our portfolio, you can see that it is fairly equally distributed, right? Okay. Now here's the point of the that we had to come to, right? The first thing that I want you to keep in mind is that this is not the worst drawdown, at least in terms of our core portfolio. This is not the worst drawdown that the portfolio has seen. We had seen a 12% drawdown as well. That was in mid Feb to mid March. But in terms of monthly returns, Feb and March were still relatively okay compared to October, because by the end of March and the beginning of April, the market had recovered quite a bit. So October is likely going to be our worst month. But what happens, right? So the chart that I was just discussing a minute ago, why I was showing that is that like you can see what happened from October 21 to June 22. So in these 8 months, so from mid of October to October 2021 to mid of June 2022, the market didn't go anywhere. Actually, it went down. It went down by almost 18%. I'm talking about Nifty here. But then from April of 2023 to now, it went up 73%, right? So you never know. These 6 months, these 8 months of pain that you will undergo, okay, you will correct 10%, 20%, whatever you correct, but these may be the ground, or these may set up the base for a next rally, which may be much higher, right? I'm not giving any guidance. I don't have any qualifications, but this can happen. This had happened in the past as well. So that is something that we have to keep in mind, and we have to stay invested. We cannot give up at the bad times, right? If you have been there in the good times, you have to be there at the bad times, and this will improve your conviction in your strategy also, and you will know yourself also better as an investor. Okay. What is going to be my strategy if the market falls further? And there is quite a bit of chance that the market is going to correct even further. Although I don't hope it on anyone, including myself, but it looks like that is going to be there. October typically has not been a very great month anyway, and neither are, I guess, November and December. Although I have not looked at the data for that. But my strategy, if I have to come to that, is to, as I was saying, pause fresh entries if the portfolio equity curve goes below 200 DMA. And why I'm talking about the portfolio equity curve is, so in the original strategy, I had said I had taken Nifty 500 as a proxy for to make this decision, right? The problem with Nifty 500 is that the large cap weight, the mid cap weight and the small cap weight of Nifty 500 would be very different from those respective weights in my personal portfolio, right? For example, if there are 3 stocks in the portfolio, and let's say everything is equally allocated, let's say we're starting, right? So 15% gets allocated to the small cap stocks, right? But in a 20 stock portfolio, but in Nifty 500, small cap would never get to the allocation of 50%, 15%, right? Small cap is maybe like 10%. You look at Nifty 50 also, a major chunk of the the weight in these indices are taken off by stocks like HDFC, Reliance, TCS, and all this, right? So the nature of the index is kind of different, and that's why a better gauge to make this decision is not to look at the 200-day moving average of the underlying index, but the 200-day moving average of your equity portfolio. And how do we do that? So I have a fairly simple thing of like let's say this is only a rough sheet, but I plot the daily portfolio value, right? So what is the portfolio value? Basically the number of stocks, like if you have X stocks of stock A and Y stocks of stock B, then X into A plus Y into B, right? You just take the whole portfolio value and you plot it every day, and then you take the average of the last 200 days and you plot it. So if you look at this chart, so this is these are the first 200 days, so obviously there won't be any DMA for that, but the moment we step into the 201st day, we start the 200 DMA tracking. So now you can see this blue one is my equity curve, and the red one is the Nifty 500 with the same starting point, right? And obviously like we both have corrected, Nifty 500 has also corrected, my portfolio has also corrected, but you see this blue line, that's the 200 DMA. So when my curve closes below the 200 DMA for my portfolio, that is when I might take a decision of not doing any fresh entries. This doesn't mean that rebalancing will not happen. Rebalancing will continue happening as it is, and we will look at the stocks. We will still make exits. We'll just not make entries, fresh entries at this point. We will still make exits, and I'm by no means saying that this is the best strategy to handle such kind of sideways or slightly downturning markets. I do not know. This is just something that I'm going to stick with, and we'll see how the performance, like what impact it has on the performance. So rebalancing has to continue, and the moment equity curve closes above the 200 DMA, the moment the portfolio closes above the 200 DMA of the equity curve, then we start fresh entries again. So from there on, whenever we go to next rebalancing, there is no constraint, as we cannot buy any new stocks. So what happens to the exits? When we exits, that entire position will remain as cash in the portfolio. So that is what is going to happen. But like hopefully things do not come to that, but yeah, this is going to be my approach as we look forward to the next weeks. I hope that we are able to pair some like of the losses in October, and I hope we do not see a major correction, but nothing is guaranteed in the market, so we should be prepared for whatever is happening, right? So two other things that I wanted to mention. First of all, like the Nifty top 10 portfolio has also corrected quite a bit because of the auto stocks falling, and it is now like all the alpha that was close to like 6-7%, and that has now evaporated completely. And this I had said before also that it is very difficult to create a momentum like portfolio like this from the Nifty 50, right? There is very little legroom there to eke out an outperformance. So that is the first thing. The other thing is, you can see the portfolio earnings ratio here, right? So this had gone almost to 144, right? And now 144 or even more than that. And now you can see there is a fair bit of correction because prices have fallen, right? So the PE ratio will obviously fall, and that's why the portfolio PE ratio is at 130 now. We do not make any decisions based on the portfolio PE ratio. This is something just to keep in mind and something that gives you a sense of where the market is. So yeah, so if you like the video, please press the like button, and that's it for today, and I'll see you in the next video. Till then, take care, have a good weekend, bye bye.